key U.S. data release hit investor screens this morning, the U.S. non-farm payrolls number. The release showed almost no job creation during October, only 12,000 new jobs. But it was a month heavily affected by severe weather in the U.S. Southeast and a big labor outage at Boeing. Let's dig into the numbers with Gennadiy Goldberg, head of U.S. rate strategy at TD Securities. Gennadiy, thank you a lot for joining us. This was a very noisy report. I assume you would agree. How much is it really telling us about the U.S. labor market?
Well, thanks for having me. I think it tells you more than we think, actually. It's not so much about the headline this month, but really about the revisions to the last couple of months. Those really brought down that 3-month and 6-month moving average pace of payroll growth quite substantially. We're now just over about 100K for headline payrolls. We're actually under 100K for private payrolls. So quite a bit weaker than I think would have been anticipated in terms of the run rate of payrolls, which does tell us the labor market is not quite as robust as the September number would have told us.
Of course, what investors want to know is what's the read through to the U.S. Fed? Does it change the? Is it likely to change the tone of discussions and the decision making at the U.S. Fed?
No, I think if anything, it'll actually more reinforce the tone, the need for gradual rate cuts as the labor market just really slowly slows down or moderately slows down. I think a November rate cut, a November 25 base point rate cut is basically kind of a done deal at this point. What we're really watching for is any hints about December, about the months after. I suspect the Fed's going to play up the data dependent theme. They're still watching the data very much, and the rest of the data, excluding payrolls, has actually been relatively strong. So there could be a hint that they could potentially, pause at a meeting, whether it's December or January or one of the upcoming meetings is certainly anyone's guess.
You say in some notes that a large portion of the move higher in the rate of unemployment has been driven by job losers. Explain that fact to us.
Yeah, I mean, there's a narrative out there that the only reason the unemployment rate has gone higher in the United States is because folks are piling into the U.S. labor force, which is really a good thing. Really, in reality, it's only about half of the explanation for the rise in the unemployment rate. Half of it is people actually being laid off from their jobs gradually. What we're seeing now, at least in the anecdotal data, is a lot of companies conducting hiring freezes rather than outright layoffs. So you're seeing folks not rehired. So that natural attrition is gradually weighing on the labor market. And that's not really a very good signal for the long run, which I think is why the Fed's going to keep cutting rates gradually.
Wage growth, average hourly earnings on a year-over-year basis came in at growth of 4.0%. That's the same as it was in September, and it did match expectations. Actually, September's number was revised down today to 3.9%. It was in line with economists' expectations. How should we be thinking about that level of wage growth in the current the current lower inflation market?
So what's interesting to me is a lot of the Fed's preferred gauges of wage inflation is really not this one. It's actually the employment cost index released yesterday. That one actually came in a little bit softer than expected, and that one showed private sector wage growth at about 3.8% year on year. So it is showing that downward trajectory continuing. The interesting thing for us is if you extrapolate what's happening in the JOLTS report, the number of people quitting their jobs because they're not quite as confident in the labor market has come down. And that tends to be a very good leading indicator for wage growth actually coming down. So we have a pretty good sense that wage growth should continue to gradually slow, which is, I think, excellent news for the Fed in that it feeds through into the kind of the core services ex-shelter component, really, the prices of haircuts and things like that. I think it's very good news on the inflation front.
The Fed next makes its decision next week on Thursday, I believe, is the 7th of November. You expect a 25 basis point cut on Thursday, correct?
That's correct. So we do expect a 25 basis point cut on Thursday. We expect a 25 basis point cut in December as well, and really gradual 25 basis point rate cuts all throughout next year until we hit 3% by September. The big question in our minds, of course, is, if the data does hold up better than expected, certainly not, today's labor market report makes it a little bit more difficult to see that. But if the totality of the data holds up better, does the Fed start to hint at potentially skipping a meeting here or there and only gradually, or even more gradually, get to that 3% level?
Can I ask you about the U.S. dollar? Do you expect the U.S. dollar to continue rallying against other global currencies?
We do, yeah. I mean, you've seen rates actually move higher. A lot of that will depend on the outcome of the election. I think certainly if Donald Trump wins, and assuming we know at some point in the next several weeks, which is far from certain, you could certainly see further strength in the dollar there because of expectations of higher interest rates and possibly a better equity market reaction, because equity markets do seem to think that a Trump presidency will be more advantageous for them, both on the regulatory side and on taxes.
Gennadiy, thank you very much. Gennadiy Goldberg is head